What is quantitative easing? Well, the banking definition goes something like this. Quantitative easing, or QE for short, is a monetary policy tool used by central banks to stimulate economic activity by purchasing financial assets like government bonds or mortgage-backed securities from the open market. This means absolutely nothing to most people, so let's look at it another way. Imagine the economy is a car engine and central banks are the mechanics trying to keep it running smoothly. When the engine is running smoothly, not much work needs to be done by the mechanics. However, when the engine starts sputtering and coughing, it's time for mechanics to step in. These mechanics, the central bankers, have special tools and techniques they can use to fix the engine. Professor Richard Werner, the banking expert and inventor of quantitative easing, calls these tools QE1 and QE2. With QE1, the mechanics drain the bad oil and remove all of the sludge from the engine, helping it run better again. This cleaning prevents the engine from getting worse. In the real world, when banks make too many loans which become non-performing, this inevitably leads to a banking crisis. Well, why is this? Let's take a look at a simple bank balance sheet. On the asset side, we see some cash and various loan contracts. On the liability side, the bank has customer deposits, and in equity, the bank has capital. The balance sheet has to balance. When banks have non-performing loans, their assets shrink with the falling value of loan contracts. Because the balance sheet has to balance and the liabilities remain unchanged, the bank's capital is drained, meaning they are no longer able to or willing to lend. The economy freezes up. At this point, the central banks step in. They purchase these non-performing loans from the banks at par value, reviving the health of the balance sheet and enabling the banks to start lending again. Contrary to popular belief, this does not cause inflation. The new money created by the central bank stays in the banking system. To learn more on this, check out our next video explaining the interbank market. This is QE1. Now let's look at QE2. Imagine this time that it's not just the engine that's struggling, but the ground has become rougher too. More drastic action is required, so the mechanics don't just focus on the engine, they must also work on other parts of the car. In addition to cleaning the engine like they did in QE1, they might also have to fit a turbocharger to it, and perhaps upgrade the suspension and tyres. Now, not only does the engine run smoothly again, but it can also go faster and manage the rough terrain better thanks to all of the upgrades. Problem solved. The real-world version of this begins the same, with the central bank cleaning up the banks by purchasing their non-performing loans. But then to fix the problem of a rough terrain, like a severe recession, the central bank can also purchase performing assets from non-banks. This pushes central bank money straight through the banking system into the economy. Now, back in 2008, our car engine was sputtering and almost stalling, and bank credit was shrinking. The big mechanics of the world, like the Federal Reserve and the European Central Bank, tried different ways to fix it. The Federal Reserve used QE1, draining all the bad oil, and the US banking system recovered much faster. Moving forward to 2020, when a massive roadblock called lockdowns appeared. Despite this being a very different problem to that in 2008, and in 2020 bank credit was actually growing, not shrinking, the Federal Reserve still tried QE2 to inject central bank money directly into the economy. This was doomed to fail. It's similar to giving everyone free fuel vouchers, like stimulus checks, without increasing the supply of fuel. Well, guess what? The price at the gas station has to rise. Yes, we experience consumer price inflation. In short, QE is like the mechanic's special technique to get our car, the economy, back on track. But if used incorrectly, it can hurt the economy and cause significant inflation. It is vital to choose the right technique for the right situation. At the start, we told you the banking definition of quantitative easing. You will now realize that that definition is in fact incorrect. We'll leave you with the true definition of QE, from the inventor himself. Quantitative easing is the creation of money for transactions contributing to GDP.